Robschild. No investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Monday, November 11th, 2024. Today's episode, of course, starts with Daily Reminder Monday, or maybe Macro Monday would be another way to put it, where I walk you through the things that I think investors should have on the top of their mind every day, even though I only bring it up once a week. Daily reminder number one, the 2-year, 10-year treasury yields were inverted for over 2 years, reverting recently in September 6th, and actually we're going back towards inverting again, but we haven't inverted yet. So things will change here if we do invert again, but as it stands, we are now reverted or uninverted, suggesting that this is when the recession will begin. This is what typically happens after the inversion. Once we're done being inverted and we go back to a normal yield curve, typically the recession starts because the Fed is at that point where it's done trying to slow down the economy and instead it's trying to ease monetary policy to help things move forward, which means, it's trying to chase the market that's falling apart. And so we can expect by this metric alone that we're pretty close to a recession starting. Now, added to that, the SOM rule was triggered in July of 2024. This is triggered when the unemployment level rises enough to trigger a rule saying that every time this happens, when it goes up by this amount, it means we're already in a recession. So although unemployment is still relatively low at 4.1%, it suggests that we might already be in a recession and not even know it yet. It is also worth remembering on a daily basis that the S&P 500 currently has a PE ratio of 31. If we look back at a 150-year-long chart showing the valuation of stocks, what does a stock cost to produce $1? How much is the value of a company worth based on the dollars that they are making? Historically, we have ranged in most normal times anywhere between, say, 25 and a very low of $7 of stock earning $1 of earnings, up to 25. Sometimes things have gotten a little crazy. Some of these spikes also represent the fact that earnings have gone down, meaning the price, even if the price stays the same or even goes down in these periods, because of earnings contractions, you can get these spikes. Now, today we have not had that earnings contraction period, not yet anyway, and yet the price of stocks right now costs $30 to produce $1. I would much would have rather been buying stocks in 1949 when it was only $6 to buy a company producing $1, $6 of stock producing $1 of earnings, or in 1917, $6 there as well. Unless you believe that stocks as a form of investment has become so much more valuable than any time in the past 150 years, it suggests a PE ratio of 30.69 right now suggests that stocks are extremely expensive and therefore have a lot of extreme speculation priced into the price. And at these prices, it operates like it's a Ponzi scheme. The only chance you have at making money in buying stocks right now is hoping that tomorrow someone will buy it more than what you paid for it when it's already very expensive. Very dangerous times in stock market investing. Add to this the CAPE ratio being at 38, also known as the Shiller index. This uses, as it says right here on the website, multpl.com/ShillerPE, that the price earnings ratio is based on average inflation adjusted earnings from the previous 10 years. That's how you get this CAPE ratio. And very notably, when this is very, very elevated, it suggests that the stock market might be really, really overvalued, kind of like in 1929, right before the Great Depression, where you wouldn't see any gains in your stocks for about 30 years. A level of 31 suggests that the market had been in the most insane bubble of all time, and it caused a depression for 30 years afterward because of how insanely high the price had gotten. Now, since then, in the year 2000, in the dot-com mania phase, we got to a CAPE ratio of 44, and then more recently, we are, well, right now at a level of 38, suggesting that it is entirely possible and maybe even probable that we may not even see stock gains from this point for the next 30 years. There's even bank CEOs coming out now saying they're not expecting gains in stocks for the next 10 years because it's already priced in. Any gains that we have are already priced in. This is a very expensive market. So like I said here, this is along with no major earnings contraction, suggesting it is extremely expensive. Also, the rate cut cycle began September 18th, 2024 with a strong 50 basis point cut. The Fed was fearful then. Lately, the Fed has been sounding a bit more hawkish than they were previously. We'll see where we go moving forward from here. Very notably, though, the 3-month 10-year is still inverted. And even though the Fed is saying, well, hey, we want to focus on helping the labor market out and we're not worried about inflation taking off. Yeah, are you really? Because you're actually still restrictive. To put it into a chart, you can look up the U.S. Treasury's yield curve, and when the Fed funds rate is higher than most of the rest of the curve, it says that the Federal Reserve is currently still strangling the economy. They're still holding it back. They're still trying to, slow it down. The rates are restrictive as we stand today, still in November of 2024, even though they say they don't want to see any more weakness in the labor market and they see inflation on a path towards 2%. Interesting. With all of this in mind, the crystal ball reading remains that the S&P 500 is currently priced as if it's a Ponzi scheme, relying only on other people to bid the price higher, not based on any kind of safe valuation. The crystal ball reading also remains that there is a bear market imminent and that the Fed won't cut fast enough to save the economy. Again, when you have a high level of fiscal deficits, people keep saying, oh, well, that's why the hiking cycle, they weren't able to stop inflation because, the Treasury spent so much money. And they were right. And now they're ignoring the fact, the same people are now ignoring the fact, this is becoming a pet peeve of mine. They're ignoring the fact that on the other side of this, when you have monetary policy that is less important, less affecting the economy and the markets, when you have cuts, they are equally going to be less effective. This is one of the biggest points that I think is massively important. And I believe that's why I say this, that I believe the Fed won't cut fast enough to save the economy. And that does it for the Daily Reminder Monday. Today's episode, we're going to continue. Happy Veterans Day, everybody. The bond market was closed today because of the holiday, and it brings up a phrase I heard someone else bring up today: when the cat's away, the mice will play. I wonder how much of the market movements today were from, college kids or the real big money. The bond market is away, and what happens? Well, Bitcoin is certainly having a field day. We'll take a look at the charts momentarily. The first thing actually is a chart. The next thing on today's episode's agenda, the 2-year, 10-year almost re-inverting, as I mentioned in the daily reminders. I just need to keep an eye on this. This is the 10-year minus 2-year. We're back to a level of 0.04% difference between the 2-year, 10-year. And if this inverts again, it could suggest that we are going to actually, that the Fed is actually going to hold rates longer, higher for even longer. And we're headed more into that direction more recently. And I find that very interesting. Now, if we get below zero here, extending, it will act as an extension of the inverted state, making the eventual reversion even worse when it does happen, in my estimation. But very interesting how close we are to zero today. Now, the latest reading of this is actually from Friday, November 8th. So just something to keep us a very close eye on. Last thing on the agenda, PPI and CPI coming out Wednesday, Thursday. I think I have that backwards, but that's the main data that's coming out this week that could move things around. Moving on to the charts, today's first chart, we'll take a look at the S&P 500 closing at $6,001.34. Still holding the line here at that psychological $6,000 level for all practical purposes. I wouldn't call this a breakout above 6,000, not yet anyway. Again, with the cat, when the cat's away, the mice will play. Let's see what happens tomorrow when the bond market opens. See what, the bigger players' effects on markets will do. Next chart caught my eye today. The CME Fed Watch tool. Very notably, we only have 1, 2, 3 more cuts before we get to a terminal rate. When I say terminal rate, I mean like the last rate before the Fed expects to not cut anymore. I mean, looking at this graph, it's suggesting that higher for much higher for much longer. This goes all the way out through December of 2025 with only 3 cuts. Again, I am in the camp that because of the fiscal dominance, we're in that same situation. If you remember, I've said this a million times before, people kept having their minds be blown because rates were so high for so long, and they didn't affect the market, and so the market kept expecting a cut, and they had to keep pushing it out. Now, on the other side of this, I expect the opposite to happen. I expect more stronger cuts to be priced in soon, but as it stands right now, only 3 cuts. So, highly interesting. Part of this may include what's going on politically in the United States. My stance on it is that I think it's best to take politics with a big grain of salt. As I always say, and as Ben Graham say, when you're dealing with other countries and considering investing in, foreign stocks, for example, you don't worry too much about what politicians are doing, because politics don't run the world. Businesses run the world. People run the world. And, if we are really only seeing 3 more cuts because of what people are thinking is going to happen politically, I think it's overdone. But we'll see. Next, very notable chart of the day, obviously Bitcoin. I mean, I had correctly said on the show, when we had broken out and retested this line, that if we had broken above, I said 75,000, that we would head up to 100,000 pretty quickly. Again, this is mostly based on what I'm hearing other people talk about, and has to do with a lot of trend lines and such. But amazing. We are up. We reached a peak of 88,540 today, it looks like. Again, I'm not going to participate in this for a lot of different reasons at this point. And it being Veterans Day, people have a little more time in their hands to try to invest. Well, Good luck, guys. Good luck up there. I really hope that you can find someone else to buy your Bitcoin from you for more than what you paid for it. One thing I like to always bring up as a precautionary message is Bitcoin is not priced in Bitcoin. Bitcoin is or in oil or in gold or in anything real. It's priced in dollars. That's all people care about. People care about dollars. They don't care about Bitcoin at the end of the day. When they see Bitcoin at 88,500, it's not worth 88,500 Bitcoin. It's worth 800 it's worth 88,500 dollars, US dollars, because at the end of the day, that's what people really want. That's what people really need. That's what they need to pay their debt. That's what they need to pay their rent. That's what they need to pay their groceries, their gas bill, their phone bill. Everything is priced in dollars, not Bitcoin. So you can't help feel a little bit envious when you see the price of Bitcoin rise. And you have to, ask yourself, like, what do you want to own and why do you want to own it? So, yeah. And the answer to that right now is I don't want to own Bitcoin. So, a very speculative asset at a time like this when the stock market is so overvalued and everyone feels like, especially rich people, feel like unbelievably rich right now. Home prices have never been higher. Stock valuations have basically never been higher. Well, it's not going to take much of a correction for people to jump ship off of this whole, like, let's put our money into riskier and riskier things train, which we're on. Speaking of the dollar, the value of the dollar itself compared to other world currencies out there going up. Now, this is while gold is going down, but Bitcoin is going up. They're doing exactly the wrong thing at the wrong time in my strong estimation. Let's see how it plays out. When I see a rising dollar and a rising Bitcoin, it seems like a bit of a divergence. And I'm guessing the dollar will reign supreme here. But it's not like I do have a crystal ball. Dollar's going to win here. Bitcoin's about to crash. Speaking of gold selling off today almost 2.5%. Very large move in gold. Gold doesn't normally trade like a penny stock. So rolling over quite strongly. I'm curious to see where gold will bottom right now. From a historical perspective, I think gold is fairly overvalued compared to other stuff out there. So I'm not surprised to see it cool off here. It's nowhere near what I would consider to be very cheap. So if it got really cheap, it could become interesting, and it would drop a lot to get cheap from this level. I brought this up on Friday's show, and I think it's worth bringing up again. This is a chart of TLT. Very importantly, we had recently a lower low in the price and a higher low on the RSI. Also, a lower high in the price of TLT with a higher high in the RSI. If you know anything about divergences between RSI and price, they're very, very, very powerful indicators. This suggests strongly that TLT might be at a bottom here, and I have been loading up on TLT. I'm currently I'm a little over 55% now of my own portfolio in ZROZ and TMF. ZROZ has a little longer duration, making it more sensitive to interest rates, and TMF is a straight leveraged play on TLT. Now, while I'm loading up on treasuries, it seems like the rest of the market is loading up on junk bonds, because junk bonds apparently only need to pay 2.73% above the rate that you can get on a treasury for them to be valuable. Amazing. We're just getting tighter. This is historic. We very, very rarely get this tight between junk bonds and treasuries. I said it on Friday and I'll say it again. Would you lend your neighbor $100 to have him for a year and have him pay you, $7, $107 in a year from now to get that money back? Or would you rather lend it to the U.S. Treasury that has, the full backing credit of the entire United States behind it to get a 5% yield? So 7% from your neighbor or 5% from treasuries. That's what it is. That's how this is working. Well, it'd be $7.73 of yield versus the current. The duration is about 5 years, so the current rate of around $4.20. Just remember, if that sounds like a good deal to you, just remember that sometimes neighbors will be willing to pay you 8% more or even 20% more. So the difference being $4 from the U.S. government or $20 from or $24 from your neighbor. In that case, yeah, maybe I would be willing to lend my neighbor $100 instead of the U.S. government. But the same guy, junk bonds, it's the same person borrowing the money that has the same level of credit rating, hardly paying you any more than treasuries relative to the risk that you're taking. Unbelievably tight, historically tight. Again, this is why I am currently short a fund called HYG. This is a fund of junk bonds. Again, I love this position because if rates go up, then the value of these bonds go down anyway, which makes it harder for them to pay their payments anyway, which puts further down pressure on the value of junk bonds. Also, during the periods where people are really running away from risk and going into safety, you don't not only get a humongous discount in the price of junk bonds, but the value of treasuries tends to actually go up, widening the gap between them greatly in these junk bond bear market phases. Whenever the spread goes way up, these are periods where treasury bonds actually rise in value at the same time as these are losing value. Next is wood, still solidly in this head and shoulders pattern. If we break the neckline and go lower, this could be a major leading indicator for other markets. Oil, the oil market, not a small market. This is a cat of its own, so it is one to pay attention to. Dropping today, interestingly, 2.6%, not showing strength at all after showing trending bearish for a while now. Scrolling out on oil, I wanted to bring up a little trend line I found here that we've been sort of bumping on this line here for a while, and I'm curious if this is one of these price counts where we go 1, 2, 3, 4, 5, 6, how many knocks before we break lower. Sometimes some people say, with their crystal ball, the magic number is 7, and it ends up playing out that way. We might be there. We might be closer than we think to a big breakdown in oil, yields, stocks, Bitcoin, everything. And oil may be the first indicator to show us that. If we start getting below, especially if we break below this trend line and start showing further bearishness, that's when I might have to pull the plug on all of my stock positions at that point. But I probably won't. I like to stick to the Graham method of never being less than 25% equities and never more than 75%. Next chart, SMH. If you're following the show, I have SOXS, which did well in its price today. I still think we're in this head and shoulders top. The real kicker of recent history is October 15th engulfing bearish candle, which hasn't played out fully to the downside yet, and it looks like we're headed there. I find it very notable for semiconductors to not get a bid today, while Bitcoin is like going on a historic rip to the upside. I had previously thought that maybe, if everyone's getting really excited about Bitcoin, then maybe that could, in investors' minds at least, drive up the potential demand for more semiconductors. And on a day like today, where we're seeing a historic breakout of Bitcoin, we're not seeing any bullishness in the semiconductor industry. And so again, like if Bitcoin now then rolls over, we might see the opposite effect happen, where people are like getting even more, may even get even more bearish more quickly in the semiconductor industry. Again, I believe it's highly overvalued industry, a bubble in my estimation, because trees grow. Trees can grow very tall, but they can't grow forever. They can't grow forever. And some of you commenters say, "Oh, they can get thicker." I'm talking about height. We're talking about growing to the sky. They don't grow to the moon. They can get real big, but they don't grow forever. No industry has. Railroads, car manufacturing, nothing. We're overproducing oil now, and we're probably overproducing semiconductors at this point. Again, these companies are not selling Nike shoes or iPhones. They're selling. It's like selling copper. It's like selling oil. It's like selling. They're exchangeable from one company to another, and so they're going to be competitive. And once we have enough of them being built, this doesn't have infinite value to it. Eventually, these will be all priced as value stocks, not growth stocks. Mark my words. Next chart of the day, Nissan stock going down 3% to a value of $4.85. And I bought more. I can't not buy more. Like I keep saying, if I were to buy the entire company right now at this value of $4.85 per share for the entire company, I could buy the whole thing today, which is what it's priced at. I would fire all of the directors, I'd liquidate the company, and I'd make a fortune, because the balance sheet shows that they have more stuff than what the stock price is worth. I can pay off all of the debt. We pay off, the company has so much debt. Well, the company also has enough stuff to sell to pay off all of the debt, and then have a bunch left over for me, the stockholder. That's how this game works, guys. So unless I'm reading their balance sheet completely wrong, I'm very excited about this stock here in Nissan getting this cheap. Last chart of the day, I've mentioned MSOS, MSOS. This is a cannabis ETF. I mentioned with the new administrations coming in, this industry might not do so well, which, prevented me from diving in at, we hit the bottom, basically, the all-time bottom yesterday, and I was like, oh man, do I get back in to get another one of these epic runs? And this is one of those times where I will use the memes and politics and figure out what people are thinking. And I do wonder how low it can go, though. I mean, going from an extreme low of $5 all the way down to $4. I mean, that's like nothing. If there's any value in these companies at all, at this point, dropping 20% from its previous all-time low after already dropping 95%. I don't know. This might be worth nibbling on now that I'm looking at it. Again, this is not a penny stock. This is an industry that likely does have a longer term future to it, considering the science, the politics, where we are in our civilization, the attitudes of everything going on. But I'll have to think about it. Anyway, that's all for me and my crystal ball. I hope you enjoyed, and thank you for watching, and see you next time. Robschild.